Hello, I'm Chris Pedersen, and this is Stock Watch for Wednesday, the 31st of July, 2024. All information is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are my market observations. The ASX 200 is real close to 8,000. It's at 7,985. This is just before the announcement of interest rates and inflation numbers. Expectation for earnings season is positive right now. Only a 20% chance of a rate rise. You notice there's been no talk of a rate cut over the past 9 months. Geez, how times have changed. The Aussie dollar is 65.40. This is down from 67, but it's still okay. Here are some of my observations of the superannuation industry. I've been looking into them extensively over the past 2 months. It is not difficult, I find, to potentially outperform the big industry super funds in their overall performance. Why does our super industry have such a high barrier to entry, protecting the underperforming incumbents? Let me know your thoughts. Coal demand. This is something that's very distressing for many people. Take a look at China and India. Those are the curves going upwards. OECD countries, they're going down. That's the blue line. When you do the math, you see that India and China, their increase in demand is greater than the decrease in demand from OECD countries. Overall, this is a disaster for global warming. Concrete output in China. Well, this is an interesting chart because it tells us a lot about the economy in China. Right now, you see that the demand for concrete is slowing. This means that their infrastructure products are slowing, that their building is slowing. Overall demand for concrete slowing is not good overall for an economy. It has many side-on impacts. Here's a chart showing the price of Bitcoin. It's been a roller coaster ride, but recently it's soared, but now it's stabilizing. One comment here is that Trump is in favor of Bitcoin, at least that's what he says, because he wants their money for donations to his campaign. But the price hasn't soared because of that. It's still stagnating, but granted, it's near a top. This is an interesting chart from Jardines. This shows various REITs and the funds from operations. The industry term is FFO. You look at the individual companies, it shows their FFO. This is a good indicator of how well they're doing on a performance basis. Credit card debt in the US, well, what happens in the US happens elsewhere also. These are 3 lines. One is 30-day past due, 60-day past due, and 90-day past due. All of them are looking terrible. China, and this is government spending chart. Well, China overall is still spending a lot. Their overall government spending. It's just not so much in the local government, but the federal government. What does this tell us? It says that the huge federal government of China is asserting more control over the economy, and they're minimizing state and local control. 3 companies across my desk that I wanted to share with you. The first one is Orora Limited. Code on the ASX is ORA, and it's trading around $2.02. This is a 5-year chart. It's gone up, but now you see it's in a downtrend. Been there for quite some time, this downtrend. Looking at the numbers, though, we get a different story. These estimates are from UBS. First off, it has a market cap of $2.7 billion. The revenue growth UBS estimates from 2024 to 2026 is 5% per annum. The earnings growth for each of the next 2 years, looking forward, is flat at 0. The dividend growth is also minimal at 3%. Now, the PE on the 2026 earnings estimate of 17 cents is only 12 times. The yield on the dividend estimate for 2026 is 5.4%. It does have good free cash flow of 10%. Its payout ratio is around 65%. So who is Orora? Well, they provide fiber, can, glass packaging, and logistics solutions for the retail, industrial, food, and beverage markets. Because of the weakness in the chart and weakness in their fundamental numbers, I'm neutral. However, if it drops much more and starts to show signs of improvement, this is a company I would seriously consider pouncing on. Second company is Mineral Resources, MIN. I've covered this a few times. Stock price right now is $52.55. You look at the chart, this is a 5-year chart, it's not looking very healthy. What do? Well, they're in lithium, iron ore, and mining services for the lithium, iron ore market, and gold market. These are estimates from UBS. One, they have a market cap of $10 billion. 12-month price target, according to UBS, is $54. They have a revenue growth rate from 2023 to 2026 at 5.4% per annum. Their earnings per share, well, I broke this down into individual years because it's too hard to put into a percentage increase. For 2023, the earnings were $1.28. This year, the estimate is 50 cents. Next year, it's a negative 83 cents. And then by 2026, it should soar up to $1.19. The dividend, well, they're paying $1.90 this year, even though earnings are less, and then cutting it to zero. That tells us a lot when a company cuts a dividend to zero and does not start paying a dividend, even when they're making a profit. The PE on the 2026 earnings estimate of $1.19 is 44 times. And because they're not paying a dividend after this year, obviously the yield is zero. The free cash flow is negative 15%. As I said before, from that pie chart, MIN is in lithium, iron ore, and mining services. They have a poor outlook. Lithium is in oversupply right now globally, and it's estimated not until 2027 or 2028 that it might get to an equality in terms of supply and demand. And then by 28-30, it'll start to go into deficit, which will be good for lithium prices. But right now, it is very unattractive. I would stay short this company. By the way, last August, I decided to recommend to everybody to short at $67.43. Well, you've made good money. Right now, as long as lithium remains weak and iron ore is not rising, I'd continue to stay short. The third company I wanted to cover with you today is Generation Development Group. On the ASX, the code is GDG. It's trading at $2.59. This chart is not a 5-year chart, it's more like a 2.5-year chart. And you can see that it's been a very strong uptrend. On an ongoing basis, let's take a look at what the numbers tell us. These estimates are from Morgan Stockbroking. The market cap right now is $700 million. They have a price target of $2.56. I have my own price target looking at the PE of 30 and calculating where the price should be, and it's around $2.70, $2.75. This tells me it has still good upside. The revenue growth from 2023 to 2026 is 22% per annum, and the earnings growth in this period is 34% per annum, with a strong dividend growth of 31% per annum. Now, looking at the PE on 2026 earnings estimate of 9.3 cents, it shows 27 times. This is not expensive. The yield on the 2026 dividend estimate of 4.5 cents is 1.7%. Free cash flow is around 8% and has a payout ratio of 50%. The core business is life insurance and financial services. The life division operates as a specialist issuer of tax-effective insurance bonds. Because it has strong growth, and I expect it to continue growing, I rate it a buy. As always, if you want to learn more about anything I covered today, or you have any requests for me to cover any companies, send an email request to stockwatch@fnn.com.au and address it to me, Chris Pedersen. Hope you have a good week and that it's profitable. Thank you for your time.